meeting recorded. And I think we just go to the presentation. So this is a continuation of the previous. The first one we handled how insurance helps us mitigate on loss of income. The second one, which was heavily interrupted by internet connectivity, but we managed to share the recording. That one was how insurance helps us in mitigating health. And today we are on the third one, how insurance helps us mitigate loss of life. And I think really without a lot of time consuming, I'll just go to the presentation. If you allow me to share my screen. Yeah, that is, I hope it is visible. Okay, I think we just move on. We just look at loss of life. We normally call it loss of life because death is not a very nice word to use, and it makes people scared. But that is the truth. The first part is introduction, which we have repeated in all the presentations. But the reason why we decided to put this across is personally, I'm very passionate about demystifying insurance because people take it like insurance is a very complicated subject. And after we have gone through this, we should be able to have our people equipped with knowledge that will help them understand insurance and also select insurance products which meet their needs. And there are certain facts that we need to be aware of. I think the first bullet point was just emphasizing what I have said. And the second one is that the greatest asset that is common to all of us as people is life. It's one of the greatest assets that each one of us has. And life insurance, when you invest, you take a life insurance policy, it is a long-term investment in your life. It is not life insurance is not a short-term oriented. So life insurance is therefore purchased when somebody is young because that is the time it is affordable. Because the younger you are, the cheaper it is because the cost is based on your age. And unfortunately, the younger you are, that's the time that individuals argue that they don't have money, but it's good to note that when you get a little bit older, you will find it a little quite expensive to afford, especially life insurance. And we went through this quotation, which is looking at three people who are born at different times, a spate of 10 years, 1977, 1987, and 1997. And the 1977 person, we saw his age next birthday is 45. 1987 age next birthday is 35. And 1997 age next birthday is 25. And each one of them wants to take a 10-term assurance policy. And for the 45-year-old, his policy will mature when he is 55. The 1987, his policy will mature when he or she is 45. And 1997, the policy will mature when this person is 35. And we assumed that each one of, for ease of comparison, we assumed that each one of these wants to put in 5,000 on a monthly basis. And the benefit as per the life tables or premium tables, the benefit that is generated by the 5,000 for the 45-year-old, it's giving a benefit of 411,722, which when you include the bonus, gives you an estimated maturity value of 658,755. The 1987 born who is 35, the policy will mature at 45, and he expects to purchase a benefit. You can see there is a difference of 10,000 because this person, for the same amount of money, will purchase a higher benefit of 421,750. The estimated maturity value is 674,799. And for the 25-year-old, the monthly premium still being at 5,000, will purchase a higher benefit of 423,000, and the estimated maturity value for the benefits is 677,650. Then we said, assuming that these three people decide to use this fund and invest it to at a compound rate of 8%, so that they use it, the three of them decide they are going to use it as to fund their retirement or to boost their retirement fund. You can see the person who is 45 and his benefits are paid when he is 55. He only has 5 years to 60, and therefore the benefit is 967,000. That is the fund, that is the amount of benefit that he will get when he is 60. The person who is 35 has an opportunity to invest his funds for 15 years, and the 674,000 grows to 2.1 million. The one who is 25 has the opportunity to invest his funds for 25 years because he is 35, and to 60, he needs a 25-year period. And just because of the period, the length of the age at which he gets the benefit, of course, he is able to invest the funds much longer. And you can see at age 60, when you look at the three people, the one who is 25 at 60 for the almost relatively same benefits is getting 4.6 million, which is quite a significant difference. And this just re-emphasizes the point that the best time to purchase, the younger you are, the better. If you are 30, it is better to buy insurance at 30 than to buy it at 40. Even if you feel like at 40, you'll be able to afford, but the benefit will be much compromised because of age. We have also done an endowment assurance comparative. The other one was anticipated, and the same picture has brought itself. An endowment policy is one that pays once. Anticipated has partial payout after every 36 months, or there is an inter-period payment before the policy attains the maturity age. If you look at the 1977, I've used the same ages, assuming here now they are investing 10,000 on a monthly basis, the sums assured for the 45-year-old is 1,053,000. The 35-year-old is 2,077,000. The 25-year-old is 2,657,000. And you can see the maturity value because of the bonus rate. This one will earn the 25-year-old, his bonuses will, the estimated maturity value will be 6.644 million. The 35-year-old, his benefits will be at 4.5, and the 45, his benefits will be at 1.5. And sorry, I think here there is again, because the benefits here, we are assuming if we are compounding these benefits to age 55, you see this person will get his benefits just the way they are because there is no period to invest. The person who is 35 will be able to invest a little longer and get his benefits at 55, and therefore he'll be able to to spread the premium payment period for 20 years. That is 20 plus 35 is what is giving you 55. And you can see his estimated maturity value will be 4.5, and the benefits at I think this one needs to be corrected. I'll correct it because it is supposed to grow. And if you look at the 1997 born, the person who has taken the policy when he is 25, to get his benefits again at 55, this should be 55, sorry. This person, the endowment policy tables only allow you a maximum of 25 years. So this person is able to utilize the maximum period. So you can see, being 25, he can also get his benefits much earlier at 50. And the sums assured is the 2.6, and estimated maturity value is 6.6. And if you invest these funds at and compound at 8% to age 55, he will get 9.7 million. You can see what difference it makes. In fact, even this one, I don't think there is anything wrong because we are saying we are compounding to age 55. The person is 35 and he has invested the policy for a term of 20 years. So at age 55, he will get his money. And it will be the same. There will be no issue about, there will be no time to compound because he will get his benefits as they have matured under the policy. So this is a manifestation of the importance of investing your funds earlier. You see, for the younger person, you get your benefits earlier, and you also have period to invest or to reinvest those benefits to retirement age, which gives you a handsome maturity investment fund. So why is the risk of loss of life, or what is it? And we say that loss of life is the abrupt termination of life, which may arise from accident, disease, or any other natural causes like old age, or we call them natural deaths. And why is insuring this risk recommended? It is because it is not possible to predict continuity of life. Nobody knows how long their life is going to last. then most activities affecting people are dependent on continuity of life. If you are not alive, you'll not be able to do many things that you'd want to do. Then also under the insurance cover, you pay some premium, which helps in purchasing the cover for you, and compensation is now from that pool. That is the pool from which the life office settles claims. So it becomes easier from this fund, and it also becomes faster, as opposed to if this was being paid from your own resources. So what does the insuring of the life risk give us? It cushions the beneficiaries, that is the people you care about. If you are a family person, you care about your wife, your children, maybe your parents partly. There are those who depend on you, even if probably they are not your children and you care about them. So this fund, this cover helps in cushioning those people that would depend on you. They are cushioned on death of the policy holder. And this is like a continuation of the children's education. For example, loan repayments or loan redemption on a family property. For example, if you have taken a policy or a loan to house your family, you cover that loan so that in the event of death during the policy term, during the loan repayment period, you are able to, the underwriter or the life office is able to offset the outstanding loan, and your family will continue to enjoy the property without having to pay to settle any debts. There could also be need for continuation of a family business, where, for example, the policyholder is the main investor in the family business. And in the event of such a person, probably the family will need to bring in another person, or to train or to source a person who will be able to step into the shoes of the main partner in the business. And when these benefits are paid, they will help the business source for such a person. What happens if loss of life is not mitigated? If you do not take insurance on your life, what happens? So this results in extreme exposure of your loved ones in terms of likelihood of losing family property because of inability to continue with loan repayments. The family could suffer a drop in living standards, that is your children, your wife, in the event that the main breadwinner loses his life. The family gets very hard hit. Then we also have the administration process of the deceased estate. Sometimes it is a process that takes a very long time before the court process is completed for the family to be able to access your assets or your estate. And nomination of beneficiaries under the policy helps in dealing with this, because when you nominate beneficiaries under your policy, it is not subjected to the administration process. Life benefits are not consolidated with your estate for purposes of being taken through a legal process. So it helps in releasing those funds to the family so that they are able to continue. You can imagine if school fees was to be, the children's education was to depend on the family being given by the court, the benefits of the deceased, it can be very, very tedious for the for the surviving dependents or surviving spouse especially. Then business closure on death of a principal partner. It can result in closure of business because there are no funds to help in managing that change. So how does insurance mitigate this risk? We have got insurance policies, both that can be arranged on individual basis and also group, mainly life policies. They provide lump sum payment in the event of death of an insured while the policy is in force. You can take riders or additional or supplementary benefits to the policies. One of them could be the last expense, which helps in the interment of the deceased person. And this now also eases the burden of the family, having to resort to harambes or burdening the wider family to ensure that the person is buried. Then we also have total permanent total disability, because there are instances where the individuals could suffer, say, an accident or an ailment that leaves them disabled, but it does not take their lives. And because of this, the person is not able to continue earning or doing the usual economic activities, and therefore they get inconvenienced. And what this policy does is to ensure that it provides income replacement for a certain amount of period, say like 60 months, which is 5 years, or depending on the terms of the policy. You could also have an accidental death as a rider or a supplementary benefit to a life policy. And this also provides a lump sum benefit to cushion the beneficiaries on death of the insured if it arises from accident. What this does is that when, for example, an accidental death rider is taken as supplementary benefit to the education policy, in the event of death of the policy holder, the lump sum benefit that is paid helps the family deal with the immediate needs that are required for continuity purpose. But the education policy continues in force until the maturity date, when now it starts paying for the children's education. So it is important to have this supplementary benefits. And what you'll notice is that supplementary benefits are also very cheap when you go through a quotation process. So I thought we needed to look at tax treatment on policy proceeds. For example, a life premium enjoys some tax exempt as a benefit, up to 15% of the premium paid, subject to a limit set by the tax authority. It is also beneficial in the sense that the benefits are not subjected to the legal administration process, and therefore easily accessible to the benefits. And also you don't suffer the estate tax that the insured's estate would sometimes be subjected to when their final estate is established. Okay? So I think with that, I also know that we do not have a lot of time, but I think we've been able to cover the basic facts. And in conclusion, I would say that loss of life is inevitable, but it is very difficult to handle. And insurance only handles the death financial impact. It does not seek to replace the life that is gone. And we also know that there is an unlimited insurable interest in a person's life. It is not possible to compensate a life. So with that, if there is one or two questions we can address quickly, and then we close the presentation. I'm open to questions. And even as we are thinking about questions, I just want to put it that at the last slide, you are able to access Holistic through email. You can also open this box. It is you to book a session. For example, you just click, and when you click, it gets you to put your details, and you are able to, it's also taking some time to load. You are able, yeah, it has opened. You are able to put your information here. You can put your inquiry, and we are able to get it. And you are also able to give us your comments, and then you submit. You submit it just by clicking the submit button at the end. And this way, you'll be able to keep us engaged, and we'll be able to continue interacting with those who have the access. Even when you share this presentation with anybody who sees and goes through, they'll have the same rights. You can also chat us up on WhatsApp by clicking the last icon. And unless there is a question, that is what I had to present for today. Yeah. So that is the presentation. And I think I would just end the meeting because we are also past our time by about 5 minutes or 3 minutes. And I think I want to thank everybody who has attended and appreciate you've sacrificed your time. And I hope you have found the presentation informative. And feel free to browse and to interrogate these presentations and communicate with us. I know it is not possible to absorb everything in one go, but in case of any questions, I'll be available to respond. And also, I look forward to having you as an insured under Holistic Insurance Solutions. Thank you. Have a good evening.
Thank you.
Yeah. So,
thank you.
Karibu.
Thank you.
Okay, thank you, and have a good evening. And take care and stay safe. And we continue to pray for our nation and to pray for each other. Thank you.